People talk a lot about yield curves.
We have seen peak curve inversion.
The curve can steepen.
Did the curve get steeper? No.
It's a graph that shows interest rates on U.S. government debt that mature in a few years to many decades. So why are we talking about it now? Well, the curve has started to resume what has historically been its normal shape, upward sloping. That means investors want more yield to put their money in U.S. Treasuries for a decade compared to doing so for just a few years. What makes this so key is that in 2022, when the Fed began ratcheting up rates aggressively to rein in inflation, short-term yields jumped and surpassed those on long-term Treasuries. This so-called yield curve inversion has preceded almost every recession since 1955. So that caused concern of a looming U.S. downturn under the weight of Fed monetary policy tightening. And while that hasn't happened yet, many investors say the recession is likely coming. They remember that back when the Fed in the past started signaling or actually began cutting rates to support the economy, that caused short-term yields to fall back below longer-term ones in what's dubbed disinversion or curve normalization. The recession, they say, is typically not far off from that.